Good morning. Thank you for tuning in for our third business education series. Today we have James Latta, Senior Vice President of Business Development and Relationship Management at Idaho First Bank. Today, James is going to spend some time talking to you about how to apply for a business loan and what could go wrong. Before I hand it over to him to introduce himself and get started, I want to thank our sponsors, Next Star Office and VRI Technologies. During the stream, if you have any questions, just comment on the video and we will make sure James gets to them. Without further ado, James Latta.
Good morning, everybody. Welcome. The original plan was to have us all in a room and we would share some war stories and go through numbers and do presentations of different companies to make it very interactive. And we still want to do that. So please shoot questions on the link over line and Bree can help me get those answered. We also want to start with, PPP related questions. So we can get those going first and we'll try to help you with some of the PPP questions and a little bit about the forgiveness process, which is just starting. Now, what did the papa tomato say to the baby tomato when they were out on a walk and the baby fell behind? He turned and said, "Hey, catch up." Okay, with that, we'll get started. PPP was originally 8 weeks to use the funds. They changed that to 24 weeks. Originally, 75% of those funds needed to be used for payroll expenses, 25% for other, and they've changed that to 60% for payroll and 40% for other. The forgiveness process is starting now, but be patient, especially if you have a PPP loan that was $150,000 or less. There's rumor that the government may change the format for that forgiveness and make it actually easier. And again, I believe you have until June 30th of next week or next year to apply for the forgiveness. So just be a little patient, even if you've used all those funds. So we don't have any questions. As those come in, I can be interrupted and we'll handle some of the questions to be interactive. So the art of war, one of the first premises in the art of war is to know your enemy. Well, the bank is not your enemy, but sometimes it's good to know what the banker's thinking when you come in to apply for a loan. And one of the things I'm not going to talk about is bankers. When we train to be lenders, we talk about the 5 C's of credit. Their character, capacity, capital, conditions, and collateral. That's for the lenders to know. I'll touch on those things and you can look those up online, but I'm not going to talk about it. First thing I'm going to do is give you a couple of keys to a banker's thinking. Now, don't turn off the channel because the first thing the banker's thinking subconsciously is statistical decision-making and a type 1 and type 2 decision error. Let me give you a real world example of those. If you serve on a jury, there are 4 outcomes of the decision that you are asked to make. The first one is you can vote the person innocent and they're actually innocent. The second is you can vote the person guilty and they're actually guilty. Those are correct decisions. However, you could vote the person innocent and they're actually guilty. That's a type 1 decision error. And in a way, there's no harm, no foul. You've let a guilty person back on the street, but there's no real damage at that point in time. The last decision or outcome is you can vote the person guilty and they're innocent. And that's a huge error for not only you on your conscience, but also the person that was innocent that you sent to jail. So those same types of decision thinking, decision errors are in front of a banker when he's looking at your loan. Number one, he can approve the loan and it's a good loan. Everybody's happy. We go on. That's a correct decision. Number two, he can decline the loan and it was going to be a bad loan. And that was the right decision, even though you may not be happy. At least that's the right decision from the banker. Type 1 error is the bank declines the loan. You get the loan someplace else and it was a good loan. the bank has missed out on an opportunity cost, but there's no real cost to the banker or to the person because you got the loan someplace else. The last outcome is the banker approved the loan and it turns out to be a bad loan. That's a terrible decision for the bank. They tend to lose money on those. It hurts the person that made the decision's reputation, and in the long run, it could hurt the company. The second part of what a banker's thinking is, most of you all in your companies have a 5% net profit margin to a 20 or 25% net profit margin. Anybody know what the net profit margin is for a bank? It's 0.75% to maybe 1.5%. So the profit margin for a bank is around 1% on average. That means we have no room for error. That's why we bankers are so conservative, and that's why we do miss out on some loans we should be making. The reason we're here is to help you get a little bit of an edge to one, to what the banker's thinking, and then two, if that helps you apply for your loan. We're not going to go into a lot of numbers because it's difficult to share those. So we're going to talk in general ideas and some general things that I think you can do to help yourself as we go forward and you apply for your loan. What is the banker trying to do? That's the first thing you need to be clear on. The banker is trying to do one thing. He's trying to gauge the strength or likelihood of your ability as a customer to pay the loan back and the risk that might prevent you from paying the loan back. So the primary thing the banker really is looking for is, how does the loan get repaid? We talk around that, and there's a lot of things that go into that, but that's the primary thing that we talk about. So tip number one is be prepared. I have some customers that were purchasing a $10 million apartment project. They were out of state. They were pretty sophisticated. They had very strong financial statements. These people probably had 50 or 60 different investment properties. It was two partners and a couple businesses on their own. On a Thursday afternoon, I asked them for 3 years tax returns, including all their K-1s, current personal financial statement, and I think it was like in October, so I wanted either a June 30 or September 30 operating statement on the business that they were buying. I sent that out to them at about 2:30 on a Thursday afternoon. I took Friday off. I knew I was taking Friday off. I figured I'd be lucky to get all this information back by a Tuesday. Friday morning, when I got back on Monday, Friday morning at 9:24, all 3 years tax returns, all the K-1s, history of all their real estate was there. Everything was easy for me to read, easy for me to prepare. I didn't have to go out and harangue those people for financial information. So be prepared. You don't need to take it to your initial meeting, but one of the things to impress a banker is after the meeting and he's given you a request of items, you get 1 or 2 of those deliverable items to him right away. How many have taken an improv class? Probably not many. You know, I have long arms, so I used to tend to fold my arms like this, and body language, that's a terrible way to greet somebody. I learned that people judge you or will like you or do business with you. They'll decide that in the first 6 seconds they meet you. That means you don't have time to get a presentation. You don't have the time to talk about your elevator speech. You don't have time to do much of anything. It's a first impression. So I took an improv class. I actually took 2 improv classes to help learn body language, not only my body language, but to read what somebody else was saying to me. So hopefully that gave me an edge in the first 6 seconds. Please don't go into your banker, apply for a loan and say, hey, I took an improv class. Am I going to get my loan approved? You need a little bit more than that. Be confident. Don't be arrogant. Present, you know your business and what you're trying to present much better than the banker. So present it accurately, fairly, and precisely. Tip number 2, talk about your business, your strategy, and your risks, and know how to mitigate the risks. And we'll talk a little bit more about that later. But the best person that is the salesperson for your business and shows the passion that you have for the business is you. And you're either the president, the owner, or both. And that's what the banker is looking for. How excited are you about your business? You'd be surprised how that helps you apply for the loan. I have a customer that when he sends me his financials, he has a conglomerate of businesses. He has a grocery store, a gas station, a restaurant, and a bar. They're in 3 different businesses, and he combines everything else. When he sends me his financials, he takes a few minutes and talks about, hey, revenues were up, and here's some of the things we did to improve revenues. And he'll tell me some of the bad news. In one of the years, his restaurant operation, the margins were a little bit lower because they got a little bit over in payroll. He told me what happened and how they corrected it. So he does just a couple of paragraphs when he sends me his financials. So I'm not guessing is what's happening. He's telling me what happened, but then it also gives him a chance to tell me, here's my strategy for correction. So that person, obviously, when he applied, he got the loan. The other thing a banker is really looking for as we talk through the story and the business story with you on your application are what are the key risks to us getting repaid? What are the key risks to the business? Number one, we probably look at is management and partners. I think one of the little known stories that a lot of businesses fail is because of partner disagreements or management disagreements or management arguments among the owners. I had a customer once that was a 30-year-old entrepreneur and a 62-year-old entrepreneur. The 30-year-old wanted to take every penny of the profits and put back into the company and continue to grow it for his future. The 62-year-old wanted to take every penny out and fund his retirement and so he could go on vacation. Obviously, they were equal capital partners. One person spent more time in the business. The younger entrepreneur and the older entrepreneur wanted to spend time spending the money doing other things. So we had a long heart-to-heart talk with them that their different personal strategies could hurt the company. And they sat down and worked out a compromise that they put some money back in and they took some money out. And that partnership was very successful and lasted for at least 15 years. And that was in Arizona. And I've since left that market. And very, very successful partnership. And they were both keys to the partnership. It wasn't just one person managing and one person putting in the money. Some of the things your banker will ask about is, what changes have you overcome? What change implementation have you made? What's the experience of you and your management team? Talk about your strategy with the banker and get his ideas so you get a conversation going. One of the things we ask, a lot of our company owners today are 50 years and older. So it's important to talk about succession plans. There's a very successful local company that the owner who drove the success of the company had 2 sons, and he wasn't sure which one would take over the company, or maybe he was. But he went to the length of hiring an independent consultant to interview both of the sons and help select the successor to run the company. That company today is still a very successful company here in town. One of the myths as an applicant that you should never say to your banker, a lot of times we are very well secured with primarily real estate collateral. Don't tell the banker, you are well secured with real estate. What are you worried about? Remember, we don't ever want to foreclose on your real estate to get repaid on the loan. That's a failure. One of the questions that's come up is how important is a business plan when reviewing the loan? And I think that depends on the life cycle of the business. So as many of you know, if you're starting a new business or you're a relatively new business, the SBA requires a business plan. And I think if you're an established business that's been operating for 5 to 7 years or more, You probably have a pretty well ingrained plan. So that plan might be a short outline as not so much what's happened in the past, but why have you been successful in the past? And now why are you going to be successful in the future? So the business plan for an established company, its most important would be just key strategies. If you're planning to increase revenue, how are you going to do that? If you're going to have a change in management, why does that make sense for the company? So it might not be the full business plan. It might be focused on a particular piece. Very good question. Thank you. One of the tips, number 3, might be at some point during your conversation, talk to the bank and ask the banker about his bank, his experience, his team, and what other products they have other than the loan you're seeking. So they have deposits and other products. This is important, 1, to get the banker engaged, and 2, it lets the banker know that you're looking at not just a transaction or just one loan, but you're looking at establishing a long-term relationship. And that's very important to the banker. We have quite a bit of business in front of us right now, and we're more likely to spend our time working with somebody that's going to develop a relationship versus somebody that just wants a single transaction and then they're out the door. That's not always worth our time. So how many people have taken a personality test? Okay, don't everybody jump through and hold their hand up at once. I think I've taken 4 or 5. I'm not going to tell you what that is, but if you take a personality test, it helps know you, your strengths, the type of work you like to do, but it also helps you recognize the personality of other people. And it helps you negotiate when you apply for a loan of understanding the personality, not only your personality, but the personality of the person you're working with. I'll give you 2 examples. We had a young lender that we had just taken a personality test in one of the banks I worked at. And this lender, we also helped teach her on recognizing personality traits of some of her customers. And one of her customers had a high I, high D, dominant personality, and that person needed to win. So we discovered that. And so we told her, he said, well, he always needs to win, and she was very concerned and had difficulty negotiating with him. So we said, well, if you think the rate you want to give the loan to the customer is at prime plus a half and a half a point, why don't you start a little bit higher at prime plus 3/4 and 3/4 of a point? And then if we've estimated this person's personality right, he's going to want to negotiate. And so he may negotiate down to prime plus a half and a half. And you can negotiate with him for a while, and eventually you can give him that. He's going to be happy because he has to win in every time he applies for a loan. And you're going to be happy because that's what you wanted in the first place. And she looked at us, she said, oh my gosh, this will never work. I'm not sure of this. We said, just try it. It doesn't work. It doesn't work. Try it out. She came screaming back to us afterwards. My gosh, it worked like a charm. He's never been so happy with me. He likes me as a banker now. And it's because we fit the deal to his personality needs that he had to win. Again, not always that easy to do. As a banker, I used to go down to one of the people I worked with that headed up operations. And I would sit down and review a certain issue with her and say, when I'd finished, okay, what do you think? I need an answer right away. And this person's personality was they needed to take in the information, digest the information, think about it for a while, and then come back with a solution. Once I discovered that through the personality test, I go down and do the same kibitzing with her and say, instead of what do you think? I need an answer right away. I said, I appreciate your insight. And so why don't you get back to me tomorrow or the next day, where she had a chance to think through, organize her thoughts. And she always came back with very, very strong and excellent suggestions. And that was because I fit the decision-making, not to my personality, but to hers. They were much better for it. So Again, take a personality test. You can do them online. They help you negotiate. It might also help you understand where your banker's coming from. Okay, what is an astronaut's favorite part of the computer? Well, it's the space bar. Okay, so what the banker really wants to know, I've hit this about 5 times already, is how does the bank get repaid? Remember, we only have a 1% profit margin. Primarily, we get paid from profits and cash flow. We can get paid from conversion of assets during the business cycle. We can get paid from the sale of other assets, either extra assets or ones that you don't use. We can get paid from new capital from outside the normal sources. Those are primarily the only ways. So we're going to spend a lot of time when you're applying for the loan as a banker talking about profits and cash flow, conversion of assets, sale of other assets, and capital from outside. So be prepared to talk a little bit about those when you apply for the loan. Tip number 4, have a clear and concise description of how you intend to repay the loan and be realistic. Again, be realistic. That's when you may start with your last 3 years profitability, and you also may be using projections for the next year or two. One of my jobs when I was with Citibank Arizona was I headed up the workout team for Arizona, parts of California, sometimes Colorado. And so I spent more time in bankruptcy court than most attorneys. And bankruptcy court isn't really about the law, it's about negotiating deals between the borrower or the debtor and the banker or the lender. And what happens in bankruptcy court, the Chapter 11 bankruptcy, the borrower or debtor gets in front of the judge. They have 120 days, usually longer, to put a repayment plan together. And the borrowers get up in front of the judge and say, Judge, we can do this much revenue and we can make this much profit. And the bank shouldn't worry because they're going to get repaid back like you wouldn't believe. And so we would let them make their presentation. And then we would get up and say, well, Judge, we just have 2 questions, and then we would agree to this plan. Number 1, we would like some benchmarks along the way to see that they're doing what they say they can. And let's say their plan says they're going to, be profitable within a year. And we say, Judge, we will go along with the plan, but if they're not profitable within a year, we'd like them to convert to a Chapter 13, lift the bankruptcy automatic stay, and let us foreclose on our collateral. Well, you've never seen so many borrowers backpedal so fast when their projections, if they don't make them, they're going to lose the company. So we would bring those people back to realism, and typically the judge would say, okay, you can't agree, go in the room and negotiate it. And of course, we would bring the borrower back to realistic projections, because even in bankruptcy, at the end of the day, it's better for us if the company succeeds than pays us out of the normal business cycle or the cash flow of the company versus us foreclosing and liquidating the collateral. You should, and I'm going to interrupt with a question. Has Idaho First seen any trends in what industries have had the most PPP loan applications? Good question. They probably have, but I don't know if we've sat down and reviewed those trends yet. Typically, the companies that have had the most would be the ones that you would normally think have been most affected by COVID-19. So companies that are restaurants have had PPP loans. Companies that have had to shut their businesses, I think med spas and companies that just had to shut down are probably the most PPP loans. I think, we kid about, I heard on the news that the Los Angeles Lakers applied for a PPP loan because they shut down a business, but I understand they were embarrassed so much by public scrutiny that they withdrew that. So I would say most of those have been the companies that have been most adversely affected, restaurants, and companies have had to shut down. So very good question. Thank you. One of the things you can do a little bit, that's not that important, but in the conversation, we bankers tend to start using acronyms that you don't understand. It's okay to ask what those mean. One of the big ones we talk about when you're applying for a loan is your debt service coverage. And we want to make sure that the cash flow from the business is enough to pay off the debt with a little bit extra. And there's a couple different ways to define debt service coverage. So you should ask the banker in the application process how they're going to calculate the debt service coverage. We see that most in real estates. For example, the net operating income of the real estate adventure should cover the debts about 1.25 times, and that's pretty typical across the industry. And it may be different if you're talking about an equipment loan. And it may be different if you're talking about a revolving line. There may not be any debt service coverage. It may be conversion of assets. One of the things we'll ask you, and this is when you get into a little bit of the numbers, and this goes back to tip number one, be prepared. So be prepared to talk about your changes in revenue, your changes in your margins, changes in your expenses, because all those things affect your repayment. And if you're going to see, if you expect to see in the next 60 or 90 days, let's say a change in your margins because something you know that's happening in your company, well, tell your banker about it up front, and then tell your strategy to get around it and to implement it and bring it back to where it should be. Because I think the worst thing you can do when you say what can go wrong is if you present a rosy picture of numbers, a rosy set of projections, when you knew you were going to have those projections fall off and your margins were going to get worse, then that creates doubt in the banker's mind that you have the ability to run the company. So always be upfront, even though sometimes it's bad news, just be prepared to explain, as a good business owner would, how you're going to overcome that. Okay? So you should talk a little bit about your banker and ask them about change in interest rates. We've gone through historic low rates in mortgages and other pieces of business. One of the things the bank looks at when we do term loans is what happens to this loan if interest rates go up 2% in 2 years or 3 years from now. And you might want to ask them that same question to make sure that the business loan you're getting into doesn't put the business at risk. Excuse me. Tip number 5, and we've already hit on this, but understand the risk to your primary repayment source and explain the risk and the mitigants to your banker. So a lot of customers that have revolving lines of credit at a bank, and that's one of the great things a bank is good for, because we really understand the risks involved with that. And so those aren't repaid by your profitability of the company. They're repaid by your account receivable turnover and your inventory turnover. And one of the things the banker will ask you that you should know about, do you have any concentrations of credit in receivables? Close friend of mine in Tucson many years ago started a cabinet business. In his first year, he did very well. He made a little bit of money, and he had $400,000 in revenue. The start of the second year, he had a contractor come to him that wanted him to do all the cabinets in a new, very large office building, and the total contract was $400,000. I was his friend. He came and asked me, he knew I was a conservative banker. I was probably more conservative then than I am now. And he said, what do you think? And I said, well, Brian, you're betting the company. How well do you know this contractor? Because if he doesn't pay you, you're out of business. So I would make sure you either do more homework than you have, because you don't know much about him before you accept the job. Well, as I thought he might, Brian did not listen to me. He took the job. The contractor didn't pay him back, and he took his company into bankruptcy. The good news is Brian was a very smart young man. He then went from a cabinet business to a drawer business and was nationwide successful in that. Although for the next 5 years, he didn't make a financial decision without first running it by me, at least to what I thought. And most of the time we were on the same plane. He then started, when he did the cabinet and drawer business after that, he would require 25 up to 50% down payment to reduce his risk, and he really had a very successful company. So concentration of credit is one of the things the bank will look at. And we'll also look at, obviously, as you do, your past due receivables and what are the chances those turn to losses and why are they past due? So how are those other companies doing that pay you? So what did the Papa Buffalo say when he dropped his son off for school? Bye, son. Okay, just seeing if you guys are awake. One of the things we do at our bank and most banks, we do not sell life insurance. However, so often we see small businesses where one or two people are key men to the success, key men or key women to the success of the company. And yet we look and they come to us with a large new loan request, and yet there's no life insurance on those key principles. I'm not in the business. I don't make any money from selling life insurance. You know, if you've gotten a Small Business Administration, it's often one of their requirements, but it's just something you as a businessman should think of as getting key man life insurance on you, disability on you in case one of those unforeseen things happen. We all love our outdoor Idaho, so we kayak, we zip line, we ski. Things happen that maybe normally wouldn't happen. I've had friends that have been killed in snowmobile accidents, and it's a terrible tragedy. And it's even worse when they've had a family left behind or a business left behind and they had no insurance. So key man life insurance and disability insurance is something you should think about when you're applying for your business loan. May not be required, but it's something you should think about anyway as a safeguard. So one of the things I haven't talked about, and I won't spend much time about, is collateral for the loan. Those items are pretty self-explanatory when you apply for the loan. Again, never say to the banker, you are well secured, you don't have anything to worry about. The last thing we ever want to do is foreclose on your business real estate, or foreclose on your personal residence. It's not the way we want to get repaid. So the most common thing in real estate is the business's owner-occupied property, your residence, and understand a little bit about how the banker values the property. We look at the net operating income of the property. We look at what current cap rates are. And if you divide the NOI by a current cap rate, that gives you an estimated value of the property. We also look at what can happen to the property to increase the value and what can happen to decrease the value. We'll look at useful life, especially for equipment. So the length of your loan typically won't go beyond the useful life. And sometimes there's a little guesswork in that. We can use your help in that as well. Oftentimes I'll ask customers, what is the realistic useful life? And what do you think the useful life of this is in your company? Obviously, we ask a lot about the receivable and inventory collateral as well, and we spend quite a bit of time on that. Any questions so far? We've covered this all pretty fast. We've only been in here for 35 minutes. So I'm pretty sure we're not going to be here for an hour and a half, but that's just fine. Okay, let's talk a little bit about most banks for small businesses. If you are the owner of 20% or more of the business, we will ask you to guarantee the loan. The banker's thinking is that if you're not willing to put your signature on the loan and stand up to support it, why should the bank, when we only make a 1% profit margin and you're going to make 5% to 20 to 25%. So most banks require, again, every owner of 20% or more of the business to guarantee. Tip number 6, if you're a guarantor and you have extra real estate investments outside the business and you co-sign any debt or you have other real estate loans where you're a guarantor, which is called contingent debt, provide the banker a separate list of those real estate assets with as much detail as possible, and list all your contingent debt, including the rate and the terms. That's probably one of the most important things you'll get asked, especially if you're a sophisticated investor outside the business. The reason why is, a lot of people in the 2008, 2009 recession, they blamed it on the banks, and they're partially correct. We were a little liberal with our repayment sources or with our lending without looking at the repayment sources, or we would look at loan A that we're doing and the repayment source was fine, but we didn't look at the principal that had business B, C, and D, and real estate investments E, F, and G. He all had loans on those, so our loan was paying fine. Then all of a sudden, loans B, C, and D over here were not paying. So the borrower guaranteed those loans personally and took cash out of business A to support those. And then when business A stumbled, the cash had been gone to support other things, and the whole house of cards started to tumble. So one of the things the banks learned is you really have to understand contingent liability of what the business owner or the guarantors have out to other banks that may be performing very well now, but understanding those risks because they could affect the repayment of our loan. So again, the bank can provide you that schedule, but it's also best if you work up one of your own. I had a customer in the real estate business once, very, very successful. This guy, I don't think we need to be quite as anal as this person was, but he had a little daily calendar, and every day he wrote a new lease. He would write the square footage and the lease terms, and then he would keep it through the year updated every single day. And then every one of his projects, he had a complete story of every tenant, what the lease rates were, what his cap rate was on the value, what his loan term was, what his balance was, and he had about 50 different properties. He would do a summary of those, but anytime you wanted information on one of those sheets, he could tell you up to the second what the lease rates were, how many leases he had signed or re-signed. Very successful, very organized, but maybe a little over the top, in my opinion. So, what is the difference between the people in Cairo and the people in Abu Dhabi? Well, the people in Cairo don't like the Flintstones, and the people in Abu Dhabi do. Okay, I'm going to recap, and then we'll, someone has asked, given current conditions, is it harder to get a loan for a new business? Yes and no. So realistically, it probably is because everyone is a bit worried about the future of the economy and are we headed into a major recession? We still don't know the short-term effects, I'll say in the next 3 to 6 months, and of course the long-term effects that COVID-19 has created. But given that there are certain businesses that are doing well and maybe even better because of COVID-19. And if you can explain the reason that you've mitigated the risks caused by COVID-19 and how your business can flourish, even though it's a new business, you still should be able to get a loan. And again, the SBA has been very supportive of new businesses. So for a new business, the SBA may be the way to go. And that's a whole nother set of training, so I'm not going to go into SBA as well now. One of the things you can do for a new business, if you're successful and maybe have 2 or 3 businesses, and then you have independent cash flow from another business, you might talk to the banker about looking at your primary repayment source as the global cash flow from all of your businesses. So that to understand while you're starting a new business, and in that case, you should have a business plan and you should have a clear pro forma how the business makes money. you might be able on global cash flow to support the start of the business from the strengths of other businesses. If it's just a standalone business and there's no other support, it, again, could be difficult to start a new business, but not unheard of. There are some restaurants that are still under construction and that we believe will be very strong restaurants post-COVID. They are well capitalized, they are well located, and they're from established restaurateurs that know the business and know what they're doing. And again, may have another restaurant that has supported them in the past or two that's been successful. So while that new restaurant may be a new business, again, we look at the management, the capital they have in place, and there may be outside income to help support that startup business. So that was kind of a long-winded answer. It is harder. It still depends. New businesses can be started even during this time frame. So I'm going to review quickly the tips I gave you. Number one, be prepared. Number two, talk about your business strategy, the risks in your business and how you mitigate those. Tip number three, ask questions about the bank, its team, and its deposit and other products. In other words, convey you want to build a relationship, not just a single transaction. Have a clear and concise description of how your loan is repaid. And really, that's just understanding your business and your business cycle. Again, be realistic. It's okay to dream a little bit. In some cases, you might have your optimistic projections, and then you might have realistic projections that gives you something to shoot for. Tip number five, understand the risk to your primary repayment source and explain it to the banker, explain the mitigants to the banker. And most of you know that on the back of your hand, but make sure you can explain it concisely when you're applying for the loan. Tip number six, when you guarantee the loan, you have outside investments or debts that you guarantee, make a schedule of those and present them to the banker. And of course, the other tips that you probably won't take advantage of is one, take an improv class. And number two, take a personality test to know your strengths and help you understand and read other people's strengths and how they react and make decisions. Well, we've done that in 45 minutes, so that's about half the time. Originally, we had presented, we would hand out financials for different companies and go through some what-if scenarios. And I know a lot of you have applied for loans with banks and you've been turned down and you have no reason or don't know why. And I was going to let you throw those darts at me and we would talk a little bit about that so that we could do better the next time as bankers and that you could do better the next time on your application. So I want to thank the sponsors and thank Bree for her work and the Chamber for setting this up. And I'll wait just a few seconds for any additional questions that may come in. Okay, again, I just want to thank Bree again and have a great Wednesday.